Hello, my name is Paul Wallace. I'm a capital markets writer at The Banker magazine, and I'm here with Dan McCormack, who's head of European economics at Macquarie. Dan, thanks very much for joining us today.
No problem.
I would like to first ask you about the Greece's return to the Eurobond market last week when it printed a €3 billion deal and got a large 20 billion euros of orders. I wanted to ask you what that signals for Greece. Does this signal that Greece is now making a recovery and that the worst is over for the country?
It's certainly a historic day for Greece and a historic day for the Eurozone. I mean, it really signifies, in my view, that the Eurozone crisis is officially over. Clearly, the Eurozone has come a very long way over the last 12, 24 months or so, and the fact that Greece can now access markets, and access markets at a very good yield, is really a big positive for the Eurozone.
And those yields the Greece's yield was a lot lower than people had been expecting. Turning to the rest of the Eurozone, the latest inflation figures for the bloc came in at 0.5%. Is that a big worry? Are you concerned about deflation setting in, perhaps?
I think actual deflation or sustained deflation is really quite unlikely for a range of reasons. But a negative number on inflation for a short period of time certainly cannot be ruled out. I mean, it's an overused refrain in Europe now, but we are only one shock away from deflation. So if growth was to slow for whatever reason, you could see negative inflation numbers for a while. But as I say, sustained deflation, which is what is really damaging for economies and asset markets, I think is really quite unlikely.
You say we're only one shock away from that scenario panning out. What sort of shocks are you talking about?
Well, I mean, any kind of growth shock, any kind of demand shock, that could originate out of the Eurozone. It's quite unlikely, I think, in the Eurozone because the recovery is firmly in place, but you can never rule it out. The US could slow down for whatever reason. Probably the biggest risk would be either China, which of course could be in the early stages of a financial crisis, or some kind of shock coming out of these geopolitical tensions between the Ukraine and Russia.
Okay, I was going to ask you about that and ask whether Ukraine and the Crimean situation is having any effect on the Eurozone's economy or not.
I don't think so yet. There's no material impact yet. I mean, markets are reacting to it a little bit, but only a little bit. The economic impact would get more material if real economic sanctions were imposed. And there would naturally be a response from Russia then in terms of either reducing supply of gas or increasing its price, which would be economically damaging in itself. So, if sanctions did come and Russia responded, that would probably prompt me, for example, to downgrade my growth numbers. But until that happens, we're probably fine.
What do you think is the main reason that inflation in the Eurozone is so low at the moment? Is it sort of the peripheral countries dragging the rest of the currency zone down, or is it to do with issues surrounding all the countries?
I mean, I would put it down to two main reasons. One, we are just coming out of a recession, so there's lots of spare capacity around. Corporates generally lack pricing power. And then secondly, underlying inflationary pressures are really very weak. They're very weak because wages growth is very weak, and also just the natural forces of globalization are very disinflationary. So there's just no underlying inflationary pressure there. Demand is not yet strong enough to reverse that situation. That should change in time, but not at the moment. So that's really the cause of the low headline inflation numbers that we're seeing.
You've spoken a lot about how European companies are under-leveraged. We've seen a bit of mergers and acquisitions activity, and recently there was a big tie-up between Holcim and Lafarge, two of the world's biggest cement makers. Did that deal in itself signal that perhaps European companies are a lot more optimistic now about the economy?
I think optimism is coming back amongst European corporates. It's very true that European listed corporates have low net debt to equity ratios. It's very true that they have plenty of cash on their balance sheet, probably too much cash. Their return on assets outlook is improving as the recovery is gathering strength. So there is a lot of incentive and I think a lot of pressure for European listed corporates to leverage up their balance sheet. It's a very simple way for managements to improve their ROE. Some of it will be via investment in capital goods, but some of it will be by buying other companies. And I think we're starting to see the early signs of that. The Holcim-Lafarge tie-up is clearly a huge one, but this is going to be an ongoing theme in 2014 in my view.
And what do you think it is that is still holding companies back? Why do you think they're perhaps still wary about releveraging?
Companies take a while to be convinced that economic recoveries are here. For you and I, our marginal decisions can be quite small. It can be a new CD, for example, which is not particularly expensive. For corporates, their marginal decisions are much bigger ticket items. It can be a €5 million plant, or it can be buying an entire other company. So to undertake those big decisions, you need a lot of confidence in the future, a lot of confidence that demand will be there in the future, and a lot of confidence in the economic recovery. So it's only once a recovery has been going for quite a while that corporates have that necessary level of confidence. But we're just getting there right now. You can see that the recovery's been going for 12, 18 months now, and corporate activity is just starting to grind into gear. So we're in the early stages of what I think will be probably a multi-year period of increasing corporate activity.
Dan, thanks very much for your time.
Thanks, Paul.